Now, the Indian rupee has breached a key psychological threshold. The rupee has sunk past the 90 mark against the dollar, extending an 8-month slide. The slide also reflects growing pressures from capital outflows, trade tensions and demand for dollar hedging. Now, over this part of 2025, so far the rupee has depreciated by approximately 5% against the dollar, making it one of Asia's worst performing currencies this year. The fall has also accelerated in less than a year. The rupee fell from 85 to 90, a much faster decline than its previous drop from 80 to 85. The key pressures behind the slide were the rising US tariffs on Indian exports up to 50%, which have hurt export demand and foreign investor sentiment. The foreign investors have also pulled out of nearly $17 billion from Indian equities this year, intensifying the currency outflows. At the same time, foreign direct investment, the FDI, has weakened. Net FDI has turned negative in September for the second consecutive month. On the trade front, India's merchandise trade deficit has hit a record high in October, adding to the pressure on rupee. The dollar inflows from sources like external borrowings and non-resident deposits have slowed down, while importers are rushing to hedge their dollar exposure, creating the added demand for dollars. Meanwhile, exporters are holding back the dollar sales in the hope of a better exchange rate, reducing supply of dollars in the system. Now, the Central Bank, Reserve Bank of India, the RBI, has intervened intermittently by selling the dollars, but the pressure still remains. Its forward book shows short US dollar positions of about $63.4 billion, reflecting how much it's already been committed to stabilizing the rupee. Now, analysts say that rupee has effectively become a shock absorber for the economy, bearing the brunt of external pressures, while domestic economic fundamentals remain pretty strong. If the current trends were to continue, then weak inflows, heavy hedging, tariff headwinds, and many foresee the rupee weakening further towards 91.30 rupees per dollar by the end of 2026. And this sharp decline in the rupee, despite India's robust economic growth, highlights how external pressures, tariffs, capital flight, and also global investment sentiment are weighing in on the currency. For citizens, this could push up the cost of imported goods, fuel inflation, and also raise costs for the overseas travel and education. For businesses, it amplifies the risks in foreign exchange exposure. As things stand, the rupee's path remains uncertain, and the upcoming months will be very critical for growth, inflation, and your wallet. All right, now on the broadcast, we're joined by Mr. Madan Sabnavis. He's the Chief Economist at the Bank of Baroda. He's joining us live from Mumbai. Mr. Sabnavis, thank you very much indeed for joining us here on WION. So the obvious question is this: while the Indian economy seems to be breaking records every quarter due to its domestic strength, the fact that the Indian currency has gone in the opposite direction, why do we see a mismatch here?
I think there are a set of factors which are keeping the rupee down. One, as you have already mentioned, is that the fundamentals of a balance of payments are looking a bit weaker. Trade balances increased. We're not seeing the same kind of FDI flows. FPI is in an exit mode. Then, of course, the other important factor has been the tariff deal. There has been talks of India having a deal with the United States, and the market is getting a bit hasty, should I say, in terms of interpreting this particular delay. So I think this is the major factor which has been keeping the rupee down. Because in the current situation, we have seen that the dollar has actually been weakening. The dollar index is less than 100, which means that the rupee should ideally be appreciating. But I think it's this particular domestic factor which has come in the way of the rupee appreciation, and we are depreciating. And I think the clinching factor, of course, in this particular storyline has been what the RBI is doing. The RBI has been selling dollars in the market. They've been taking positions in the forward market, in the NDF market in the past. But I think the moment we have come close to 90 and we've crossed 90, the RBI has not really been very active in the market. Now, what this really means is that the Reserve Bank may be quite comfortable with the fact that the rupee is depreciating, because in this uncertainty on the tariff environment, this could be providing some kind of an export advantage.
All right. Do you think this downward movement of the rupee is something that is planned by the RBI and the government, because this could make India's exports much more lucrative, or do you think this is happening due to factors that are beyond our control?
See, it's happening because of factors beyond our control, but it's a case of saying that if we are seeing the rupee depreciating, the central bank can always intervene, which it has done in the past. But today we're seeing that the intervention is more restricted, it's more limited. It's only at a margin, which gives us a feeling that we may not really be averse to the rupee depreciating at this particular point of time. And
Right.
that's the reason why the RBI is holding up, because we do have the forex reserves to use, which the RBI has always maintained is an armory for this kind of purpose. But the very fact that they're using it sparsely means that there could be some kind of method in the intervention.
Right. Now, despite the fact that, India is clocking some really robust GDP growth figures, where India's GDP quarter by quarter has been growing at at the fastest major economy space, do you see the foreign outflows stabilizing anytime soon, or could the risk of sentiment deepen further?
No, I should tend to think that things are going to stabilize, because once we have any kind of a deal with the US, the sentiment factor, I think that has been the most volatile element. That's something which is going to correct to a significant extent once we have a deal. And in terms of FPIs, we should just remember that if you look at some of the global stock indices, they've been doing really well. Like the Indian stock market has probably grown by around 7 to 8% year-on-year basis. Whereas if I look at what's happening in the Western countries, the growth has been even more phenomenal, sometimes 15 to 20%, which really means that opportunities are there in various markets, and the FPIs may just be reallocating the funds. But I think once we have this certainty about the tariffs about India, because 50% is definitely something which does not all go well for investors. But once we see some kind of a correction taking place there, things should stabilize. But until such time, I think we could be expecting volatile times.
Indeed. Thank you very much, Mr. Sabnawis, for joining us with that perspective there.